All right, it's 6:35. I'm sure everyone is excited for this evening session, so let's just kickstart. So once again, I'm Jason, the Wealth Advisory Lead here at Syfe. I'm part of the advisory team, and I will be your MC for this evening. For those of you who have joined us here physically or online, welcome to today's Market Outlook 2025. Tonight, we'll provide you with many insights that you can bring back and discuss in terms of your investment portfolios. We'll divide this evening's session into three main parts. The first part, we have invited speakers over there who will give us an outlook in terms of the equities market and the bonds market. The second part, there will be a panel discussion where you will have the chance to actually ask the speakers your questions. And the final part, we'll have our CEO, Dhruv, to give us his closing remarks. If you see on the screen behind me, there is a QR code. And this QR code will be your main form of interaction with us this evening. If you can scan it, you will see four main sections: 2 poll questions, a Q&A, and a survey. So the first poll has 2 multiple choice questions, and the second is a word cloud question. We'll go through the results later during the session. In the Q&A segment, you will see questions that have been actually uploaded by other audience members as well. If you have any questions, that's where you post them. Without further ado, let me introduce the speakers that we have here this evening. So first, we have Ms. Valerie Chan from BlackRock. I'm sure all of us know BlackRock, who is the world's largest asset manager. So Ms. Valerie is actually a vice president and investment strategist, and she focuses on Asia-Pacific content. Next, we have Ms. Alice Low from PIMCO, who is a global leader in fixed income assets. Alice is a very familiar face if you've seen the last couple of sessions that we have done. She's currently an executive vice president in the Singapore office and the head of Singapore retail business. She brings a ton of experience in terms of the investment and the financial services. Last but not least, Ritesh, who is representing Syfe. He's the managing director and head of investment and advisory. Ritesh is also responsible for the overall development of Syfe's investment product suite. For the benefit of those who are joining us here this evening for the first time, and you're not familiar with Syfe, I'll give a quick 30-second introduction. So Syfe is a digital investment platform, and we seek to empower our clients to build their wealth for a better future. We have a mobile-first approach. You can see on the screen over here. It's a mobile app where managed portfolios, cash, and brokerage services are available in a single app. This is a very quick snapshot of our journey to date. I won't go too much into the details. You've seen this slide many times. Last point that I wanted to raise was actually, we've done a fundraising in 2024, and in the same year, we have also launched our downside protected portfolios and our SRS solutions as well. Right, without further ado, let me just invite Ritesh, who will give us the opening remarks. Ritesh, please.
Hi, everyone. Thank you for joining us today. It's a pleasure to see all of you here. Let me kick off today's session by giving a small glimpse of what happened in 2024, and it was truly an extraordinary year. So 2024 actually began with prospects of a recession looming large, but it was proved otherwise with a surprisingly resilient US economy. I'm just trying to get my clicker as well, sorry, yes. Strong consumer spending, inflation steadily decreasing, and then Federal Reserve finally pivoting and starting its rate cutting cycle. On the political side, we also saw one of the most impactful events for 2024 with the re-election of President Trump back to the office. And that brings with it a lot of potential policy changes as well as uncertainties in the market. So how did we fare in 2024? It was a truly remarkable year across asset classes. So if you look at the slide, the global equity markets rose close to 18%, and S&P 500 rose 25%. And this is after a 24% return that S&P 500 generated in 2023 as well. So back-to-back returns of more than 20%. And this has happened after mid-90s for the first time ever. So obviously backed by very strong corporate earnings, as well as still dominated by your AI stocks. Looking at the other side of the world, Chinese equity markets also rebounded on the back of late policy support coming in as well. And it was not just the equity markets that actually shined. You see, gold was the best performing asset class at close to 27% return in 2024. And this was at the back of, again, it being considered as the safe haven asset amidst all this political uncertainty. Now, looking beyond these markets, there's also the global bond market. And within the global bond market, it was a more moderate return that you saw, still positive at 3.5%. But most of the potential returns that were supposed to come because of interest rates being cut were pared back a bit with Trump getting reelected and the longer end of the yield curve moving up as well. One more, I think, before I move on to this, another asset class that I didn't have in the slide was basically Bitcoin. So astonishing results there as well, 122% returns coming in there. And, with more favorable regulatory changes, that was one surprise that everyone saw. And, a lot of investors starting to get a little bit more confidence into the digital asset space as well. This quick slide of the suite of products that Syfe has on our platform as well across saving solutions, income solutions, and growth-oriented solutions, along with trading that you can also do on our platform. Highlighting first the income, because I want to just give a quick peek on how the Syfe portfolios performed in 2024 compared to the broader benchmarks. So if I just zoom in into Income Plus, so our Income Plus solutions both generated better returns than the benchmark. I told about the global aggregate bond market, which was 3.4% in USD terms. So in SGD, it is 1.4%. And both of our income portfolios were, outshining the market. This portfolio, again, powered by PIMCO. So we use PIMCO funds and, the asset allocation guidance, given by them as well. And on top of, the returns, they generate a very consistent dividend yield between 5 to 6%. Moving ahead, the REITs market, and we have a very, flagship portfolio for REITs as well. Unfortunately, REITs have been a bit of a struggle in terms of return generation over the last few years, and it continued in 2024 as well, where you see the REIT market, negative, ending up negative for the year. So the index, which is the S-REIT Leaders Index, was negative 6.8%, and our portfolio slightly outperforming, but still negative at 6.5%. So I think, from a REITs perspective, obviously it's been a bit more challenging, and more of the REIT returns, in my opinion, were driven by the more macroeconomic factors than the more local, things that are happening. Because from a Singapore standpoint, the economy is super resilient, economic growth is super high. If you look at all the REITs, the occupancy levels are at, again, very high levels, and the rental reversions are also very, very strong. So I think it's just a matter of time when REITs, do have a comeback. And as interest rates continue to come down, we might see a rebound in 2025. And then coming into the core portfolios, we have our flagship, equity and other combination of equity, bond, gold portfolios. And all of these portfolios also continue to outperform the broader indices as well. This is, again, at the back of some major enhancements that we did onto our core portfolios, including, exposure to more small caps, value, and other sectors. So diversifying beyond the Magnificent Seven stocks, as well as, we optimized it from a UCITS and tax efficient purposes as part of our rebalancing late last year. Now, as we step into 2025, obviously, we are entering into a very new phase, a phase that will be presenting both challenges as well as opportunities. Now, one of the most focal points of 2025 will obviously be the policy rollout that happens under the new Trump administration. And within that, I think it'll be important to understand from a standpoint of how he implements his tax measures, the tariffs, as well as, the America First strategy. So the implications of that could be fairly beneficial for certain sectors, but it could also prove to be, having some headwinds on some other sectors as well. On the other side, the actions of the Federal Reserve will remain as the center of attention for all of us, wherein they need to balance their dual mandate of, fostering economic growth at the same time, keeping inflation in check. Meanwhile, China obviously will be a critical driver to the global growth, and it needs to address both its internal challenges as well as the external risks that the new administration of Trump entails as well. And amidst all these uncertainties, the reality is that there is still some things to remain optimistic about, including all the technological advancements that are happening, and particularly in AI, which will continue to shape our future as we move forward and will present plenty of opportunities for us as investors. So, how do we prepare for 2024 or 2025 as we move forward? There are these 4 key trends that at Syfe we have identified in our investment team that will shape 2025 and beyond. So how will the Trump 2.0 administration take shape? What will be the Fed actions as we move forward? China's policies driving the global growth, as well as AI advancements. These themes are central to our outlook as we move forward. And today we have speakers, expert speakers from both BlackRock as well as PIMCO to share with you more deeper investment strategies, insights, as well as guidance in terms of how can you prepare yourself to navigate through the market uncertainties, the challenges, as well as the opportunities. So thank you for being here, and let's dive in. Thank you.
Thank you, Ritesh. Up next, we have Ms. Valerie from BlackRock, who will share with us the equity markets.
Test. Yep. Thank you. I'm Valerie from the BlackRock Investment Institute, and today I'm going to share the global outlook and with a bit of a focus on equities. So how then do we think about 2025? So we are in a new regime with mega forces that's reshaping the global economy, leading to diverse potential outcomes that's possible. So this contrasts instead with the pre-pandemic era's deviations where we saw a very steady trend. So for decades, economies have followed steady and long-term trends where investors could then focus almost entirely on navigating any temporary deviations from these trends. And ultimately, growth will then converge back to trend. So however, what we see currently, the environment is different. So we've termed it as the end of the Great Moderation, the new regime. So the current environment is different because economies around the globe are being transformed by mega forces. So you might have heard this term before. It includes the rise of artificial intelligence, includes geopolitical fragmentation, diverging demographics, and also low carbon transition. So these forces will continue to shift the long-term trend, which makes various outcomes possible. So we don't just look at one line ahead, but rather it's extremely unpredictable where the outcomes could lie. So this fundamentally upends the nature of investing. So we think that investors now have to find opportunities by tapping into the waves of transformation that we see ahead in the real economy. So AI, low carbon transition, these are aspects or mega forces that would require investments that is potentially on par with industrial revolution. And we do expect that capital markets will then play a pivotal role as the infrastructure build-out happens. And the other aspect for investors is to focus more on themes, less on broad asset classes, given that there's no stable long-term trend and the outlook is going to be ever evolving. So investors might want to reconsider what a neutral asset allocation is and instead put more weight on tactical views and be more dynamic generally in your portfolio. So this might be a familiar slide for some of the audience. So how then do we define mega forces? Mega forces are big structural changes that is affecting investing now and into the future. So these are drivers in the new regime that is resulting in greater macroeconomic and also market volatility. And they will change the long-term growth and inflation outlook and could in fact create big shifts in profitability. So for investors' perspective, there will be major opportunities and also risk. So here we outline 5 mega forces that we are tracking in no ranking of preferences, but today we do want to focus more on AI, given there's always keen investor attention on it. So in our view, AI holds great potential. It has attracted significant investment. And in the short term, we do expect the AI story to drive moderate productivity gains as AI is shaping up the tasks that we do on a day-to-day basis and also being adopted in industry practices. So but then I think if AI gets to a larger scale and drive innovation at a bigger scale, the economic impact will be through a broader supply capacity, a lower inflation pressure, and also to boost economic growth more meaningfully. So then how do we think about the AI evolution? So we frame it in 3 phases. So first, AI would require the initial large-scale infrastructure build-out across industries. The second phase will be the adoption, so the broadening of adoption, which could be quite uneven across sectors. And the third phase, which we are not yet there yet, is transformation. That's where companies can then unlock the full value of AI adoption and see the broad productivity gains that AI promises. And that's also where maybe when we look into companies, new business models will appear, new industries could also emerge. Then what then is the investment implications? I think firstly, the ongoing AI infrastructure build-up phase is still offering quite good and significant opportunities. This includes the enablers, so essentially the cloud infrastructure, the chips maker, the data management systems. But we also see the opportunities extending beyond technology. So that would then include the sectors such as utilities, industrials, energy, and also real estate, where they are involved in the build-up of the infrastructure. Then how then do we think about the mega cap technology firms? They will remain the key beneficiaries in the build-up phase. So, but along the way, maybe some of them will lose the AI race to others. But in aggregate, we do think that the mega tech firms will continue to surpass others given their unmatched resources and also their technological expertise. So in the competition, they will be in the lead. Otherwise, I think other ways to get exposed will be through private markets to fund the infrastructure and also to continue to watch out for future winners that might appear in unexpected areas. So they might not be sectors that are adopting AI, but yet can capture fully the value of it. So 2024 is a year of major elections. However, in 2025, we do expect that the drive for political and economic reforms to persist. So economies and markets so far have proven to be quite resilient and adaptable. But 2025 will be a year where it will test that resilience. And we may start to observe through the short-term decisions, given that the governments are frequently changing power, and that will prompt governments to make short-term decisions and swiftly enact their agendas, which means that they will pursue policies that add to volatility rather than to stability. So in the current fragile global landscape that we are already in, and with the intensified competition between US and China that we're all closely watching, policy making could then emerge as a source of disruption in markets. So we think that, say, a reduced focus on macro stabilizing policies from the policy making angle. So say if they stop relying on fiscal frameworks and rethink about inflation targets, that would then trigger financial markets to enforce discipline more frequently. So rising bond yields could moderate expensive fiscal policies. And then we can also expect sell-offs in risk assets, say if a policy is going to hinder growth. So, and we have also seen a significant increase in protectionist measures coming out of the COVID crisis that is contributing to the rewiring of global economic relationships. And trade tariffs that will be the central focus of Trump in the current US administration. We think that if some of these tariff proposals are implemented on a maximum basis, that's as he's mentioned during the campaign, that could disrupt the global economic and geopolitical environment. So it all depends really on the execution and then what's the subsequent reaction in the other countries. So here we have observed increased market sensitivity to economic data surprises. And this is, in our view, a reflection of investors interpreting new information that's through the lens of a typical business cycle. So rather than considering the broader transformations that are reshaping the economy. So since 2020, we have long argued that the current environment that we are in is not a business cycle, but a series of structural shifts. And looking back at 2024, we are seeing evidence that support this perspective. So firstly, in a typical cycle, US growth should have decelerated with tightened financial conditions to reduce inflation. However, we have not witnessed this. Inflation moderated, but growth persisted. And then the financial conditions has also eased into since the late of 2020, well before the Fed cut rates. And that has been attributed to the surge in US equities. So we think that it is crucial for markets and investors to avoid the mistake of interpreting incoming data solely through the business cycle framework, but rather consider the evolution of the mega forces that is happening around us. And here we lay out the possible scenarios in the near term. We constantly update this with new insights and revisit it as we think that the path should change. But at this point, we recognize that the US corporate strength, which we see in the equities market, goes beyond the AI sector. We think that the US corporate strength scenario will be the most likely scenario over the next 6 to 12 months as earnings growth broadens beyond tech, and even if the economy slows down by a bit. And mega forces will then create further opportunities and demonstrate the resilience of corporate earnings, even if interest rates remain high. With all that laid out, we think that the following three themes would be top of mind for 2025. Firstly, financing the future. We think that capital markets will play a crucial role amidst the infrastructure build-out. Second theme, rethinking investing. So investors will have to place greater emphasis on thematic investments rather than broad asset classes, as major forces reshape the entire economy. And also, given that there's a lack of stable long-term trends and an ever-evolving outlook, we cannot rely on the fact that eventually there will be convergence back to historical norms. But it is then important to place more weight on tactical views, be more dynamic with your portfolios, and also to think more granular. And the last point, the last theme involves staying pro-risk. We have increased our overweight position in US equities, and we do expect the AI theme expanding further. So I'll leave here for a short moment our big cause for 2025. So we remain pro-risk, and we do prefer to take risks in stocks. So we like US equities and Japan equities, which I will go on and touch on later. And also we prefer to be more selective in fixed income. That's more for the 6 to 12 months horizon. Okay. Yes, so we have more conviction in US equities, outperforming their international peers. So compared to international peers, which is the yellow lines that you see, we think that US will benefit more from mega forces. And mega forces are boosting corporate earnings, and US continue to have a favorable growth outlook. And then on top of that, what's driving US equities is the momentum that is coming through with Trump administration's campaign promises with potential tax cuts and deregulation. So that led us to increase our overweight. So what we observe in the market is there's going to be further divergence across markets that is going to widen even further. Consensus expectations here are for the US to continue to lead on earnings. And so far earnings we've seen that's been driven mostly by tech sector, and we expect that to continue, and we are closely watching for the upcoming earnings season to see that if that derails from our expectations. But outside of tech, we do expect earnings growth from the other sectors to also pick up. And looking at the other sectors, valuations there is not as stretched. So the whole broad market would then benefit from the strong outperformance this year. We get a question on valuation. So US equity valuations are at the historical high. But we do think that historical valuations are more relevant for long-term returns. And given the megaforce effect on the sector composition, we think that it's no longer a fair comparison to compare valuations against history anymore. So these comparisons are no longer apple to apple, they're much less straightforward. So bearing in mind the megaforce impact, we do think that US outperformance could continue. Next, Japan, which we also have an overweight on, and we have held that overweight for some time, given that there's a brighter outlook in Japan, both on the micro and also the macro level. So on the micro level, if you followed the TSE announcements, there's ongoing corporate reforms that is happening in the Japanese markets, led by regulators, to enhance shareholder returns. So the left-hand chart here is showing share buybacks. So share buybacks is now exceeding previous historical levels. And also there's going to be greater dividends we've already seen happening. And also with the TSE enforcement to improve shareholder returns, companies are also rethinking on their profitability. And on the macro level, we are also seeing the return of mild inflation. And these higher wages that are being imposed are feeding through to inflation. And the outlook for the Shunto wage negotiations that's happening this year is also reflecting that it's again going to be a year of strong wage growth. So ultimately, what does this mean? It means that there's going to be greater pricing power for corporates, and hence earnings is going to be well supported. And underpinning our view is the BOJ normalization to be quite gradual. So no instability in market due to policy surprises. So we hold a tactical overweight position in Japanese equities, and also in the strategic horizon or long-term portfolios, we hold at above benchmark positioning. And last but not least, Europe. So we are seeing Europe's macro picture improving. The economic recovery is beginning to take shape, even though it's quite uneven across like the different countries within Europe itself. Inflation is falling and is fallen close to the ECB's 2% target, which means that it's paving the way for rate cuts. And we think that rate cuts in Europe is going to be faster and deeper than in the US. So, and with the rate cuts, lower policy rates is going to reduce the propensity of Europeans to save. So that is the macro picture, which looks quite optimistic. But if we take the macro forces lens on Europe, we do think that it's less of a beneficiary of long-term trends than when we compare that against to the US. But equities-wise, how then do we think about it? So the picture of European equities is quite mixed. So we see the historical valuation discount of Europe equities to US equities. It does suggest that there are some of these negatives that are being priced in. But when we look at it from a whole portfolio within the European space, we think that the equities story is lacking catalyst. So instead of focusing on the broad asset class, we are looking at opportunities more on the sector level. So for example, we like financials. Given that they have healthy balance sheets, they are getting better fee income, which could then offset the lower interest margins due to the rate cuts. We like industrials. We see that as an indirect play of the global AI build-out, and also a beneficiary of some of the reshoring that we are seeing in DM markets. And then last but not least, we like utilities, given that there's going to be stronger energy demand, given that data centers are continuously expanding globally. So with that, I'll stop here and pass it over back to Jason.
Thank you very much, Valerie. Before I pass it over to Alice, I'd just like to gently remind everyone, there are Q&A available. So if you have questions, please feel free to post those questions online. Right, up next, Ms. Alice, who will give us in terms of the global fixed income outlook.
Hi, good evening, everyone. Very happy to be here today, and I would like to share with you our outlook on the global fixed income markets. So just now you heard from the previous speaker, seems like BlackRock is pretty positive on equities, less so on fixed income, but over the next 15 minutes or so, I would like to share with you why we think that bonds still remain as a very crucial part of your portfolio in 2025, both as a portfolio diversifier against equity risk, but also on a standalone basis, we think that bonds provide a lot of value for investors in the form of generating consistent income as well as a driver of returns as well. Now, what is our base case outlook for 2025? Our base case is that we are expecting a soft landing across developed markets. So that means that it's a pretty positive scenario overall, growth to remain positive and resilient across most developed markets, and inflation to continue trending downwards towards a 2-point-something% kind of range. Not exactly at central banks' target levels of 2%, but still continue to moderate. Now, that is actually pretty good news because as inflation continues to remain under control, this gives central banks room to continue cutting rates into 2025. So that is our base case scenario, meaning we think the more likely scenario to happen. But of course, we do need to take a bit of humility and acknowledge that this base case scenario, we cannot assign a super high probability to it. Now, our latest outlook, we title it, you can see on the top, Uncertainty is Certain. So that just means that we should expect a lot of uncertainty on the horizon. If you look out, you heard from the previous two speakers, there is a lot of uncertainty in the market today. There's geopolitical risks, and particularly with Trump in the White House now, you will see a lot of unpredictable US policy pivots potentially. So that could introduce a lot more uncertainty in the market. So number one, with more uncertainty in the market, that means the range of outcomes becomes a lot more wider. So it again is important to position your portfolio for a wider range of outcomes. And that also means that you should stay diversified across asset classes. So again, bonds and stocks both have a place in your portfolio as they can provide you with the diversification. Now, a lot of people may say, but back in 2022, 2023, bonds did not provide that level of diversification. So that was a very different era where we have seen back then, because we were coming out from the pandemic, inflation was coming out, spiking out of control. They were reaching around high single digits, 10%. So, and you can see over here, the red line shows how swiftly the Fed and other central banks hiked rates to contain the inflation. So in a very high inflationary environment and central banks embark on very aggressive rate hiking policies, that's when the negative correlation between stocks and bonds, they tend to break down. We are not in that kind of scenario any longer. As I've mentioned, inflation across most developed markets have actually come back down towards central bank targets and are remaining under control. So the negative correlation between stocks and bonds are reasserting itself. And so the power of bonds to diversify against equity risk is back again. Secondly, and so our expectation is that, I mentioned just now, base case, central banks have room to cut rates. And so over here, we look at US as one example. The red line, as I've mentioned, is the current Fed funds rate. The Fed has already cut 100 basis points, 1% since September last year. We think that there is further room for the Fed to cut. Of course, when we look at the expected range of the neutral rate, so how much can the Fed cut? How do we come to that estimate? At PIMCO, we rely on a lot of experts to help us think about central bank policy, for example. To give you a few examples, we have the chair of our PIMCO Global Advisory Board, none other than Dr. Ben Bernanke. He was the US Federal Reserve Chairman during the time of the Great Financial Crisis in '08. We also have Dr. Richard Clarida as our Global Economic Advisor. He was the vice chair to the Fed under Jay Powell during the COVID period as well. So all these people are sharing a lot of their experience and insights with us and help and guide us to think about potential central bank actions and policy outcomes. And so our expected range in terms of the neutral rate for the Fed is around the 2 to 3% range. And so we do think that there is further room for the Fed to cut. Of course, I mentioned just now, Trump in the White House introduces a fair amount of uncertainty. He has threatened to impose tariffs, right? 60% on China, 10% base tariffs on everyone else, and then most recently, he said that he may impose 25% tariffs on Canada and Mexico in February. So now, the thing is that we do think that some tariffs are to be expected. Trump believes that tariffs will work, and so we do expect some form of tariffs coming from the Trump administration. However, we also do think that his bark is potentially worse than the bite. So he can talk a lot about tariffs, but at the end of the day, he's also pragmatic. He's also a businessman. So we also think that a lot depends on the implementation, but we don't think that tariffs are going to result in a widespread inflation to come back. Even if Trump were to implement what he proposed, 60% tariffs on China, 10% on everyone else, that would mean that in the worst case scenario, inflation could tick up by maybe 1.5%. And that's assuming he does everything that he threatened to do. And we also don't think that that's going to happen. If you look back in the first presidency, back in 2016, he also implemented tariffs, but depending on how you implement it, it did not actually result into very widespread inflation. So all in all, what I'm trying to say here is that whilst, yes, it could introduce some volatility and uncertainty into the market, we don't think that it's going to be to the extent that we would expect the overall direction of rates to significantly change from here. So overall, generally, the direction of rates, we think, should still be coming down. What it could mean is that maybe instead of cutting rates earlier, the Fed stays on hold for a little bit longer. Okay, so it's more of maybe delaying the rate cuts rather than potentially rate hikes. Of course, never say never, but we do think that the possibility of rate hikes is lower at this point in time. So what does this mean for investors in general? So I mentioned just now that the Fed has already cut rates by 100 basis points, 1% since September, and a lot of other central banks globally have also done so. So we think that given central banks have already started their rate cutting cycle, bonds still provide a lot of value, especially compared to cash. Your cash rates have already started coming down. You can see that's in the blue line. Cash rates have already started coming down very quickly as central banks cut rates. And as and when we see further cuts, the cash rate will continue to come down. So by staying in cash, you have that reinvestment risk. You are renting a yield. Whereas in bonds, we like to call it you actually own the yield for longer. You can lock in these higher yields for a longer period of time. So you can see that right now, bonds are back into an environment where they are out yielding cash. And so from a yield generation perspective, bonds actually provide much better value than cash. And why else is it important to look at the yield in bonds? So when we look at the yield in bond markets versus the expected, or rather versus the forward-looking returns. So the blue line here shows you the yield of the bond index. The green line shows you the returns 5 years out. And you can see that these two lines closely overlap each other. There is a 94% correlation between these two lines. So this gives you the sense that the yield in bond markets is the single best predictor of forward-looking returns. Now the yield now on the US aggregate index, that is a very high quality bond index. You can think of it as the equivalent of S&P 500 in the bond markets. That's giving you around a yield of 5% at this point in time. So that means that if you are buying into the US aggregate index today, over the next 5 years, you should be expecting a baseline return of 25% over the next 5 years. That's not even assuming that rates come down or at all. So assuming that rates stay where they are, you are going to earn that yield. I mentioned just now that we do think that the direction of travel for rates over time should still be on the way down. So as rates come down, you should still expect to see additional capital appreciation on top of this base yield that you're earning. So number one, where are the sources of returns for bonds? Number one, locking in these current high yields and earning and owning your yield. Number two, potential capital appreciation if and when rates come down. And number three, active management. So now that is just the market return. And through active management, by scouring the world to unlock further value, right, looking for where are the opportunities within the bond markets, we can also potentially add on additional returns for investors. What do I mean? So first of all, when we say bonds look attractive, own some interest rate risk, where you own that risk is also very important. So over here, I show you the yields of different developed market government bonds and also emerging market bonds. So obviously, emerging markets give you a higher yield. You take a higher risk, you get a higher yield. Let's not even look at that. Let's just compare the yield that you're getting across all the different developed markets. Now, the US is in blue, and you can see other developed markets, Germany, UK, Canada, Australia in green. First of all, you will see that the bars right now, the solid bars, are much higher than the shaded bars. And the shaded bars were pre-COVID. So you can see that yields have now reset to much higher levels. Again, to my point, you are locking in higher yields at this point in time. Secondly, we also find a lot of value in global diversification. Right now, the US is giving you similar yields as the UK, Canada, and Australia. So regardless which market you're investing in, you're locking in the same level of yields. But guess what? The growth dynamics across all of these markets are very different. So in the US, we see the US growth being a lot more resilient. For example, you look at the jobs data in the US, it shows that the US labor market is still very robust. And actually, another reason why the US, we think, is going to remain more resilient is because a lot of the US consumers are less affected by the current high interest rate environment. In the US, majority of homeowners actually lock in their mortgage rates for 30 years, 30 years. And majority of them actually managed to refinance their mortgages when rates were close to zero 2 to 3 years back. So over 2/3 of the US homeowners have locked in their mortgage rates at 3.5% or lower. So in a way, the current high interest rate environment is not affecting them as much. So one of the reasons why the US economy has stayed fairly resilient. In contrast, countries like UK, Canada, Australia, they don't have this kind of mortgage dynamics like they do in the US. So a lot of the consumers in these countries are feeling very acutely the effects of the high interest rate environment because it hits their mortgages directly. So we expect in these countries, growth will be slower compared to the US, looking in the next year ahead. And that also means that the central banks of these countries, the Bank of England, the Bank of Canada, the RBA, they are likely to cut rates a little bit faster, a little bit more aggressively as compared to the US. So whilst you're earning the same yields right now, there is higher potential for capital appreciation in these markets. So again, having that geographical diversification, we think, is one way to unlock more value in the bond markets. Secondly, not just geographical diversification, but also across different types of bonds. Not all bonds are created equal. And how do we look for value across different types of bonds is to look at the valuations. A good asset at a bad price is still a bad investment. So you need to look at whether the valuations are attractive. And so over here, we look at the valuations of different types of bonds versus the last 10 years. Those on top, the first 3 rows, the diamonds on the right side, that shows you that versus the last 10 years, it's currently trading cheap. The diamonds on the left, that means that versus the last 10 years, is trading currently expensive. So you can see that there is a lot of divergence in the bond markets. And so in actively managed portfolios, we favor the types of bonds that are currently trading cheaper. So to give you just quickly one example to really compare and contrast the difference. The third row from the top, agency MBS. MBS stands for mortgage-backed securities. What are these? Simply put, these are bonds that are backed by thousands and thousands of home mortgages. And these actually carry an implicit guarantee by the US government. So they are actually considered default-free, same as US Treasuries, and they carry a AAA credit rating. And these agency MBS, because they are trading cheap, they are giving you a yield of 5.3%. In contrast, when you look at investment-grade corporate bonds, so these are good companies, but because these are corporate bonds, they are not default-free. So the average investment-grade credit, and so that's the green line, third from the bottom, that's the average credit rating of an investment-grade corporate bond is BBB. So lower in quality, and yet they give you a lower yield as compared to agency MBS. So again, this is one of the reasons we think that having an active approach to managing fixed income is also very important for you to unlock value in the bond markets. So to summarize my sharing today, we think that bonds are very well positioned to provide anchor in portfolios, that diversification, but also on a standalone basis, we think that they offer very compelling returns. Yields are now at levels that we have actually back at levels that we saw around the time of the global financial crisis in 2008. Yields that you can lock in right now, and that will help you to generate much more consistent returns over the next couple of years. Having said that, again, have an active approach to fixed income investing. Not all bonds are created equal. There are better opportunities in some parts of the bond market than others. So we think that it is important to, again, to take that diversified, active approach. And I'll stop here. Thank you.
Thank you, Alice. May I please invite the other speakers up on stage? We'll proceed to our next section. Right, so while we're waiting for the speakers to join us up on stage, I'll just show you very quickly the poll results. So earlier we asked you 3 very simple questions. First of all, how did your investment portfolio perform in 2024? 35.6% of you mentioned between 10 to 20%, right? The next, okay, next one. 2025, the next question. And what were your expectations for this year? And majority of you actually said 10 to 20%. Right? The last question that we actually asked you was a word cloud. And this is a very interesting thing. Most of you actually said diversify. The second most popular one was Bitcoin. All right? I'm very thankful some of you also said Syfe. All right? All right. So without further ado, I'll just pass over the time to Ritesh.
Thanks, Jason. Thanks, Alice and Valerie, for the great insights that you shared earlier. Let me kickstart this session by asking you a few questions from my side, and then we will also open it up with Q&A from the audience. So I think Jason mentioned that there are questions that are already available with the QR code. So if you have any questions, please keep posting, and we will try to address as many as possible. We might not be able to address everything, so if we miss them out, please do reach out to us post the event, and we'll be happy to address it then. All right, I'll kickstart with you, Valerie. Essentially, there is this belief that high interest rate in US equities is going to persist in most of the audience. And one detail that I noticed in your presentation was that BlackRock still considers the US equities as a tactical opportunity over the course of the next 6 to 12 months. Why is it not a more, strategic and long-term, allocation at this moment? And are there any specific sectors that BlackRock is particularly bullish on?
Yes, actually on the tactical horizon, we are actually hawkish and bullish at the same time, which is why we still like US equities, even though we are expecting higher for longer. But you're right to point out that in the strategic horizon instead, we are neutral DM equities. So we would prefer EM equities over DM equities, given that in the long term, we factor more into the valuation story. So post-COVID, what we saw is that the valuation discount between EM and DM has widened and has been increasing. But instead, what we are thinking on the strategic horizon is to look more into granular. So we see potential in more specific sectors like IT and healthcare. So one aspect of it is through the megaforce lens. But what we are also seeing is that in the IT sector in the last 2 decades, margins has expanded. And we do believe in our expectations in the next 5 years at least is that this expansion will continue. And healthcare is also at the crossroads between megaforces, not just AI, but also the demographic dividends, the diverging demographic megaforce that we have highlighted. So we like these two on the strategic horizon, but I'll just briefly touch on the tactical horizon too, since we're at it. So earlier on, I've talked about broadening of the AI profile beyond tech, and we like things like utilities, industrials, energy, and real estate companies. But we also like financials. This is with regard to the rolling back of banking regulations expected from the Trump administration. And we also like healthcare, which we want to take advantage of the cross currents of mega forces, both on the short term and the long term. But we are also seeing the early positive impact of AI technology in this space being used in drug development. So when we go granular, think about companies that has technological edge to help them actually navigate the market in the competitive market much better.
Thanks, Valerie. I'll come back to you with more follow-up questions, but let me shift gears a bit on the fixed income and the macro landscape again. So Alice, after Trump's re-election, obviously the interest rate outlook has shifted again, right? Like there is concerns that there will be inflation that will kick in again, plus there might be US, fiscal deficits. So what are PIMCO's views on these aspects, and what are your views on both the short-term as well as the long-term rates?
Sure. Just now I talked a fair bit about the direction of the central bank policy rates, and so that's the short-term rate. I mentioned just now that our view is short-term rates, which is the central bank policy rates. We think that there's still room for them to come down. If you look at the current market pricing, markets are actually basically expecting for the Fed funds rate to go from currently 4.5 to around 4% by the end of this year, so another 2 cuts from the Fed, but stay at 4% for the next decade. So I think that we think that is actually quite interesting, because in over the next decade, we think quite likely you would see some shock in the market. In the last 10 years or so, we've seen so many cycles. And once you see a downturn, we will likely see the Fed cut rates back down. So we do think that current market pricing, it is not, a lot of investors have not taken into account that there could be more negative growth scenarios that would actually necessitate more cuts from the Fed and other central banks. So that's one. You mentioned Trump. As I've mentioned just now, we think that whilst Trump can introduce a bit more volatility into the inflation outlook, overall, we also don't think that it would actually be to the extent where we would see a repeat of the 2022 and 2023 kind of scenario. What happened in 2022 and 2023 to cause inflation, to get to such high levels was more supply-related shocks because of the pandemic. So we are not seeing that at this point in time. And as I've mentioned, even if Trump were to enact the 60% tariffs on China, 10% baseline on everyone else, that would mean that inflation takes up by about 1.5%, which is nowhere near the kind of levels that we saw in 22. Now, to your last question on the deficit, so that's interesting because if we expect right now the U.S. deficit is around 6 to 7%, very elevated, and we do expect that to stay at that level, if not even higher, going forward. Because if you look at a lot of the government spending needs that the U.S. has, a lot of these they can't reduce it. So 3/4 of the U.S. Government expenses is either your mandatory expenses such as your medical, the medical expenses, social security, or even interest expense of current debt obligations. So all of these, it won't go down. So we do think that the debt deficit is likely to stay elevated, and we also think that by the end of this year, as the tax cuts expire, we think that Trump is likely to extend them. So again, this will add to the deficit. Now, this could be problematic, but we also see that that's how, again, active management can help to mitigate some of these concerns. So as the US debt deficit is going to remain elevated, we think that there's going to be increased funding needs to fund this deficit. So that means that longer term yields in the US is likely to go up as the supply continues to come online, to increase. So in our actively managed portfolios, then what we can do to mitigate this risk is to actually avoid or even outright short the long end of the US yield curve. So that will actually stand to benefit as rates in the long end move up.
Thanks, Alice. Great perspectives. Coming back to Valerie, we talked about emerging markets, and you said that we are more pro-EM than DM in the long term. What are the particular opportunities that you see within the EM domain? Obviously, there is the Trump overhang that we need to consider in the more near-term perspective and all. And also, there are two major economies. There is India and China, for example, right? Like, those two are the mega forces that is driving, the greater APAC kind of ecosystem forward. And we had seen, I think, on the last year and a half, there was a significant movement out of China and into more kind of like India equities and all. Do you see that trend continuing as we move forward? Also, maybe if you could touch upon Southeast Asia and the region a little bit more specifically.
Yeah, so tactical or strategic?
Both, I guess.
Okay, so I'll cover the tactical view and then I'll cover the strategic views. So tactically, we do have a modest overweight on China equities. I think we did read from the government's policy signals that there will be more policy easing that's going to come through. But then the scale of that will also depends on what US trade actions would be. So, but essentially, it is what kind of policy measures that they roll out that would impact the sentiment. So what we are looking out for is policy measures that could target consumption, given that there's clearly a lack of consumer confidence in the market on the consumption side of things that is weighing on the sentiment for the market. So measures that could rebuild this consumer confidence will be critical, and these have to be done on a very sustainable basis. And China has also focused previously on traditional investment-heavy growth measures. So we do think if they focus on that area, the impact on growth would be more moderate. So the question, it really comes through to what the government does. And we do see an opportunity to be modestly overweight, given that there's still a significant discount of Chinese equities versus DM shares. So that made us turn tactically overweight in the near term. But we are going to be quite nimble on that. We will change our view if the stimulus, the progress coming through from the stimulus front continue to disappoint. And also if the trade restrictions appears more detrimental than we thought it is. In the long term, on the other hand, China, we are more cautious. We focus more on the structural challenges that are in China. So geopolitical is ongoing, and it is going to continue to weigh on this long term from a risk perspective. And then also, China has a problem of aging population, and looking at the long term, we do think that it will continue to weigh on its growth outlook with a declining population in China. So within the EM space, strategically, I think we like India. So India is in the crossroads of all the other mega forces that we have. It has a young population. It is pretty advanced in terms of the AI space. Geopolitical, India is multi-aligned, so we see them pretty neutral between the US and China. And also other factors in mega forces that is supporting the India view. But for India, I think the main question has always been valuations. And when we look at PE valuations and all, it does look expensive on the near term. But in the long term, our team has forecasted the equity risk premium in our model. And in fact, it does screen pretty cheap in the long term if we look at it on an ERP basis. So we are overriding the traditional measures of assessing markets by PE valuations, and we favor India in the long term. Okay, that's EM. I think you have asked about Southeast Asia too. Yeah, Southeast Asia, I think, would have a bit of a diversification story, given that how Southeast Asia is very different. The countries in Southeast Asia itself is very different from each other. So I think comes the question of the tariff implications this year. I think that will be top of mind. Exporters would definitely be more impacted. Hence, the focus is more tilted towards domestic-oriented economies, so places like Indonesia and the Philippines. But I think the policymakers in the region are also leaning towards a more dovish tilt. So to what extent can these policymakers cut rates this year? I think that will also provide some support to the market itself. And we've seen in the recent surprise cut by Indonesia, the Bank Indonesia, when markets are not expecting them to do anything for that meeting, they went ahead to cut rates. So the balance between growth and other priorities, I think that mix could change from the central bank's perspective in the year. So that is something that we should watch. So clearly in Indonesia's case, they have prioritized or balanced growth with also its preference for market stability in the case of FX. So I think that would be quite interesting. So policy and also the developments on the tariff front.
Thanks, Valerie. There is this idea that we are entering into a new paradigm where the US exceptionalism will continue as we move forward, right? Like, with Trump, and if you saw just, I think yesterday or day before, there was like this thing about US entering into a golden era. So there is like $500 billion being committed to AI investments coming together of OpenAI, Oracle, as well as, SoftBank. How do you think, amongst the mega forces that you talked about, will it really lead to just a dominant factor of the US market, or will there be more things like beyond, as you mentioned, in the EM and other spaces? So maybe a little bit, number one, will the dominance within the US will continue, and within US, will it continue to be dominated from the growth and tech kind of, aspects?
Yes, so with regard to the recent headline on the investments in AI led by Trump, and then including OpenAI and so forth, SoftBank, etc. So we think that is kind of like playing out in the megaforce space on AI. So we've talked earlier on about AI requiring more infrastructure. So this is a case where infrastructure could be more supported by private equity, private investments. And clearly the government's investments, and we had a chart somewhere else, but we had a chart where we showed the amount of government is investing in this infrastructure versus private, and it is actually on par. So I think that the role of private coming in to support infrastructure investment would be very important, which is why we are also highlighting our preference for private markets. But yeah, we haven't really discussed about it today. But otherwise, we do think that the US exceptionalism, especially from the angle of tech, will continue to dominate, given that the mega caps, they are really ahead of the curve in terms of its expertise. So they would continue to remain competitive. But then if we look more broadly, I think other countries do have players in the supply chain that is also supporting this tech AI story. So a case is Taiwan, TSMC, in Taiwan, where the leading semiconductor company has dominated the index and also have been a main play for the AI story. So we do think that there are definitely other ways, other beneficiaries, and we've already seen the rally of that. So back to your question, there's going to be more broadening out of AI adoption. But at this moment, what we are seeing is a huge part of the investments is coming in US, and henceforth, I think a lot of the impact will be seen in the US itself.
Thanks, Valerie. Moving on to you, Alice. One of the things that you talked about was reinvestment risks in cash. Maybe if you could allude a little bit more on that front, especially in the context of Singapore dollar, right? Like, you know, how the current cash rates are and how could investors potentially elevate and enhance their yields through bond investing?
So the thing is that in the context of Singapore dollar, I think we can all agree that the fixed deposit rates have also come down quite significantly over the last couple of quarters. So the thing is that, as I've mentioned earlier, when it comes to reinvestment risk for cash, say for example now you put your cash into a 3 months, 6 months fixed deposit, you still get a pretty decent yield. But the question is, when that fixed deposit matures, are you able to roll that into another fixed deposit at the same rate? And chances are maybe yes for a while longer, but then chances are you might not. Already, like I said, compared to a year ago, rates are already much lower. And just now I showed a chart where bond yields right now are actually above that of cash. So by investing in bonds, yes, you do take some mark-to-market volatility, but at the same time, you are actually earning these higher yields for longer as well. So the idea is that as rates come down, then not only do bonds provide you that higher yield, you get that capital appreciation. If yields don't come down that soon, that's fine, because you are just clipping your higher coupons for longer. So in a way, it's a win-win situation. Now, question is, will interest rates move in the opposite direction? There's a lot of chatter about how potentially all these high inflation risks coming from Trump and whatnot may cause rates to go back up. Like I said, it's never say never, even though that is not in our base case. But at current elevated yields, you actually have a very decent cushion against further interest rate increases. Even if interest rates were to move slightly higher from here, your yields are much higher. So even if you take a bit of that hit from rates going up again, it is still going to be positive return. Because back then, we were at a much lower starting point, right? Your yield was not very high, and then you get a hit from rising rates. So obviously, you had negative returns in bonds. But now, your starting yield is a lot higher. So you have that buffer. Even if rates go up a bit more from here, you are still going to get positive return. And that is more of like a fairly low probability scenario. The more likely scenario is you're going to clip these higher coupons for longer, and at some point when rates come down, you're going to capture the upside as well.
Thanks, Alice. Very helpful. Coming back to the US equity market, there are questions plenty of questions from the audience which talks about the current high valuations of the US equity market. Plus, I guess there is this view that potentially the US market may broaden out, given that the earnings, the growth in the earnings have started tapering a bit. It's still more than 20%, 25% in the mega cap space, but the small caps and the medium cap stocks have started picking up on earnings. So will that change happen sooner or later, or what's your view as we move forward when investors look for opportunities in the market?
So our view on valuations for the US equities, I think I've mentioned earlier briefly that in this transformation that we are in, the current the current valuations are not as stretched because we look beyond whatever valuations that we are looking at. So for US equity valuations, I think the traditional measures are price earnings ratios, ERPs, all these look rich compared to its history. But that's compared to history. So when we look at the sector compositions in the index itself, I think that has already shifted to more weight on the mega caps and less on the ex-mega caps names. So if we compare the current valuation, the valuation of the current index with its current composition versus something of the history is definitely not apple to apple. So it does make a comparison of where the fair value valuation should be quite challenging. And when we take, we do have tactical and strategic horizons. So we do think that valuations would then matter more for returns more in the longer term horizon than in the near term. So we would, factoring the megaforce impact that could continue to drive the equities market higher, that could leave earnings growth of all the other tech names higher. We do see that some of these valuations could be quite warranted to factor in this transformation.
Any views on mid caps, small caps, and
sectoral
changes, anything on those fronts?
Correct. Small caps, we are neutral, but we do see, I think we focus more on the sectors rather than the size of the company. So I think the broadening out, I think that is where we would still prefer. So tap on the thematic views because that is how we should be also thinking about taking advantage of these mega forces rather than playing the size of the equity markets on a relative basis. But for small caps, we do think we are quite neutral on that.
Thanks, Valerie. I'll take a couple of questions for you, Alice. I think there are two things specifically on PIMCO. One is, PIMCO is heavy in US. How do you view that risk now, considering, sorry, just went away, went on the top. Considering increase in credit card delinquencies and commercial loan defaults?
Right. So I think this is interesting. And again, I just now in my presentation, I talk about the importance of active management, right? The importance of being selective when it comes to where to invest in the markets. Even though we say that generally, the outlook for bonds is positive, again, not all bonds are equal. So again, this question, it really underscores the importance of active management. So for example, yes, we do see that there are pockets of, a bit more vulnerability, right? And so then we want to avoid some of the areas that, that you may see a little bit more concern. So for example, increase in credit card delinquency. So first of all, within asset-backed security space, so that would actually be hitting more of your asset-backed securities that are typically backed by all sorts of non-housing related loans, such as credit card loans or car loans, student loans, etc. So within PIMCO, in the asset-backed space, we actually have much less exposure towards, say, for example, asset-backed securities that are backed by credit card loans, for example. Where we favor within the asset-backed security space would be more high-quality student loans, for example, especially those student loans that are taken out by students pursuing professional degrees, likely to, for example, lawyers, doctors, those likely to get a job and also have enough income to pay back on their loans. So again, having that very selective approach in terms of which part of the market to invest, that's important. Specifically to commercial loan default, so yes, commercial real estate is also another area that is come under the headlines. I would say that even within the commercial real estate space, there is a lot of divergence. So for example, the sectors of the commercial market that are under pressure would be retail and offices, right? Retail because of the shift towards online spending, online shopping. So a lot of the brick and mortar retail they are coming under pressure. Or office, because a lot of there's this regime change of working from home, right? So these are sectors that are a bit more under pressure, but there are also other sectors within commercial real estate. So this is a very broad category that we see a lot of tailwinds. So for example, hospitality. Everyone is doing revenge traveling, right? Hotel rates are super high right now. I'm sure all of you can relate. So sectors like that doing very well, or even things like I think both my fellow panelists are talking about AI, right? So data centers, these are also classified as commercial real estate. So these are actually areas that are bright spots. So again, having that very selective approach to investing in sectors even like commercial loans, that is important as well.
Thanks, Alice. On that note, and given conscious of time, let me first take the question on the outlook for REITs for 2025, and then maybe I'll ask a couple of closing questions, and we will wrap up. And if you're not able to answer all the other questions, please do reach out to us post the session as well. So let me just quickly address how to think about the REITs market in the present context. Now, REITs have really had like a triple whammy of sorts. If you think from the last 3 years, it's not been easy investing into REITs. We started off with the pandemic, so really, it had a big impact in terms of, no one is going out, so basically all the real estate assets were, in a bit of a shock state at that moment, and, people who were having these different rental properties, they had a little bit trouble in terms of generating revenue. So there was that shock first to deal with. Then interest rates started to move up, and that had an impact again from a cost of borrowing standpoint on the REIT side. And then, as soon as last year, particularly what happened was towards the middle of last year, as soon as there was announcements of rate cuts going to happen, REIT market actually started moving much more positively. But it was soon derailed close to like September through November period, as soon as there was more speculations of Trump coming back to power, and that had implications from an inflationary standpoint, and that led to the longer end of the yield curve again moving up and impacting again REITs more particularly. So I would say till now the REITs market has been impacted more because of the broader global macroeconomic implications rather than the more domestic aspects, which remain very, very strong in my opinion. Again, I think I pointed out earlier as well, the Singapore economy is very robust, growing north of 2.5% plus. And when you look at more specific REIT sectors, etc. as well, there is, from an occupancy standpoint, whether it is rental reversion standpoint, all of these look very, very strong. And on top of that, when you look at valuations of REITs, they're trading at currently 0.8 times book, price to book valuation, as well as when you look at the difference between the yield of the REITs versus the government bond yields, it is close to 400 basis points or 4% difference that the REITs market is currently giving. And both of these are signals that definitely there is currently REITs at an undervaluation standpoint. And it's just a matter of time when, if interest rate trajectory continues to move in the lower side, we should see a bounce back in REITs, particularly in 2025 as we move ahead. Maybe just a couple of closing questions more on the roles of the different asset classes, both equity and bonds in a portfolio. As we are thinking about allocating our capital moving forward, what is the roles that equity and bonds can play in an investor portfolio? We've talked about things like 60-40 as the ideal moderate allocation. Is that something that still holds? What would you change?
Sure, I can start. We think that a 60-40 portfolio still makes a lot of sense for investors in this current environment. I just now touched upon it during my presentation where we see that the negative correlation between stocks and bonds have come back as inflation comes back down towards more normalized levels. So definitely for investors, it is important to remain well diversified. And I also mentioned earlier that our base case for the global economy is still a soft landing. And a soft landing means that growth remains positive. That's positive for equities. Inflation continues to come down, rates to gradually continue coming down. That's good for fixed income. So overall, our outlook for both equities and bonds is positive. But again, not without uncertainty. So which is why, again, bonds really provide that diversification benefit versus equities. I'll just leave you with one more point, which is that if you look back historically, over the last 3 decades, this is using data going all the way back to the early 1990s, a 60-40 portfolio actually gives you similar returns as a 100% pure equity portfolio. Okay, so the difference in returns is about 0.6%. So you're not really giving up, you're not sacrificing much returns by diversifying a portfolio from 100% equities to a 60-40. However, because of that diversifying power of bonds, you are reducing your overall risk by close to 40%. So again, not sacrificing returns, but reducing your risk meaningfully by having a good mix of 60-40 equities versus bonds instead of a 100% equity portfolio.
Any thoughts from you, Valerie?
Yeah, our thinking is a bit more different. I would say that in the midst of the transformation, we are in a new regime. So we have seen evidences that traditional concepts of investing has broken down. So with megaforce developing in the horizon in the decades ahead, that investors will have to rethink about 60-40, 50-50, or what makes sense anymore. And also what we are also noticing is that there's also a fairly erratic correlation between stocks and bond returns. And that is fairly an attribute of the new regime that we are in. So allocations between bonds and stocks, yes, you have to do it. And in our outlook, we highlighted that there is also potential for other diversifiers, old like gold, new like Bitcoin. So gold, we've seen, has surged to diversify portfolios against high inflation, and also central banks are using it as alternatives for major reserve currencies. So yeah, we do think that having gold in the portfolio while being nimble with them still is important. And we have to closely monitor some of this relative performance of these assets against other traditional asset classes. The other thing is the investment case for Bitcoin. We've done some research on it, and we do think that there's going to be a significant widespread adoption of Bitcoin. And that is going to continue to support the returns of that. So for traditional 60-40 portfolio, we do think that a 1 to 2% exposure of Bitcoin would be a fairly reasonable range. And that 1 to 2% is comparable to the same share of the portfolio risk as accounted for by each of the Mega 4-7 stocks on average. So I'll leave you with a food for thought.
Very interesting. Thanks, Valerie. Maybe just last question, how would your next 100K allocation look like, given what you guys just talked about?
I'll go first. Short answers. I'll focus on mega forces. Continue to watch for not just the big tech, but also where are all the other opportunities that could benefit from it. And then mega forces is not just AI. There's also geopolitical uncertainties that's driving, supply chain relocation, There's also diverging demographics, so you can play the old population versus young population. Old population doesn't mean it's a bad thing, but it's more like what we are monitoring is where then the old population could see greater spending. So more healthcare, maybe more technology related to to support their later part of their aging process. So yeah, so these are some of the angles that we can look at things, be more thematic and be more nimble and more dynamic in your portfolio.
Thanks, Valerie. Alice, 60-40, anything changes?
I would still put it in a 60-40 as the starting point. Anything else on top of the 60-40, I think that to the extent where it's accessible to you.
Alternatives, for example?
Yeah.
Would you consider
exactly.
like private credit?
Yeah, so to the extent that it's accessible to you, then alternatives could also be a diversifier. But of course, within alternatives, also again being selective. So for example, there's been a lot of interest in private credit. For example, private corporate loans, right? As opposed to the publicly traded corporate loans, corporate bonds. We think that investors are not really getting enough compensation in these private corporate loans. Because right now you are giving up liquidity, but you're only getting, say, 1% additional yield on top of your publicly traded counterparts. So where we actually think that within the alternative space or the private markets, it looks a lot more attractive would be, say, asset-backed lending. So this would be like mortgage-backed securities I mentioned earlier, but not traded publicly, but in the private markets. So some of these areas where we still find a lot of attractive value can prove as good diversifiers to your portfolio. Bitcoin, I just want to say, personally and also from a firm view, we have less conviction in that because number one is still extremely volatile. I think we all can agree with that. Number two, I don't think there is still a fundamental way to value Bitcoin and other cryptocurrencies at this point in time. So it's very hard to say, how do you value crypto, right? And number three is that we've also noticed that in times of market stress, when you really need diversification the most, actually crypto also behaves like any other risk asset. So does it really provide that diversifier in the portfolios? Questionable.
Yeah, I think the question is more on the diversification part, but from a return standpoint, I mean, obviously, a lot of people have seen the meteoric rise of Bitcoin. So I guess the interest is still there, and only the future will tell us how things unfold. So let's wait on it. But thank you so much, both of you. Lovely having you here, and thank you for sharing all the sessions. We'll move on to the next set. Jason, thank you guys.
Thanks a lot, Ritesh, Valerie, and Alice. All right, before I pass the time over to Drew for the last 5 minutes of tonight's session, I just wanted to share a last question that I received. One of my clients was asking, as a financial advisor, what's your take on buying Toto, right, for the $10.8 million, right? So my answer was, I'm sorry, I'm not qualified to advise on such matters. Please consult your local Toto specialist, right? All right, last 5 minutes, we'll pass it over to Drew. Drew, please.
Thank you, Jason, and I promise to keep it less than 5 minutes. Firstly, a big thank you to Alice, Valerie, and Ritesh for a very insightful session. A lot of topics have been discussed, and there was it's always like, learning new things and getting different views, so really appreciate it. The other thing, a big thank you to everyone and my fellow colleagues at Syfe who've managed to pull together our largest event till date. More than 400 of you in this room, I think many more hundreds or maybe thousands online around the full numbers. But thank you for coming out here. Now, one of the questions out here was, what is in store for 2025? So maybe I'll just quickly start off with a quick summary of what happened the year that went by. So it was quite an interesting year for us. We started with bundles on the brokerage side and a bunch of features which launched at different points. But I want to highlight maybe 2 or 3 things out here. I think firstly, we actually became profitable as a business. And this is a big milestone for a relatively young company. One of the questions that always gets asked is, oh, you're building this model. How's it ever going to scale? How's it going to be? But given the persistence we've had as a business and the fantastic growth we've had in the last year, we actually turned out profitable here in Singapore. On back of that, we actually ended up raising a fantastic fundraising round of 36 million Singapore dollars. If you've been following the startup ecosystem, this is actually quite an exception. If I remember correctly, there have perhaps been 3 fundraising rounds since we raised a round, which again gets to tell what we've built and what we intend to build as a business. We also launched some really stunning features such as protected portfolios. We've obviously expanded further on Hong Kong Exchange side. The big development and a big ask of a lot of you was SRS eligibility, and we launched our SRS offering in November last year, and it's actually had a pretty amazing uptake, right? And lastly, with all this growth, we now cater to over 250,000 users here in Singapore, and that's quite a scale if you think about it. So if I look at all Singaporean adults, we are probably covering about 6 to 7% of them already and growing very rapidly. So thank you for your faith in us in doing this. Now, we've also been a year of fun and giving back. We've started with mentorship, especially for younger students who are understanding about finance, understanding about their own, how do they think of their careers and their future. We also built on, and we please, if you can, next slide, please. Okay. Well, I think there are a few images, but no worries. We'll probably get into this section, which will talk a lot about what to expect in the next few months. Now, everything's not here because we would love you to come for our subsequent events too, to learn what's coming in the months that follow those. But one thing that I'm very excited about is we are going to launch the most affordable and one of the best way to access UCITS ever Singapore has seen. This thing should go live as soon as the next few weeks, so you've heard it first out here. So please keep a look on your app for this. But this is going to be cheaper than even Interactive Brokers, which everyone says is the cheapest. So rest assured, and it's going to be brilliant when it comes up. We've also extended our offering to businesses. This was actually a small beta experiment where some of our customers who were employees of certain businesses or even small business owners had asked us, could we actually manage corporate treasury? And just in, it's not even public, in just a little bit of a reach out, a little bit of, website upgrades, we now already manage north of $100 million in just corporate treasury. And this has been growing quite well. So if you are a small business or you're part of a corporate, something to consider. We have something for, this AI is not the AI we've been speaking about all evening, but this is more for accredited investors. We're going to be launching a few bespoke solutions, which should be coming hopefully in the next few months, as you'll be able to see. And lastly, a big ask of a lot of you has been eGiro integration, which will make at least transfers and all quite seamless. Now, this is just all in the next few months. There are some actually very big initiatives that we are working on, and I would love to share them as the months and quarters go by. Now, in closing, when I do these closing remarks every year in the market outlook events, I would love to say that, hey, everything we said and everything we wanted was 100% correct. That would be a lie. But I'm happy to say that a lot of things we called, a lot of things we said, actually did end up panning out the way we expected. But the one thing which we've always said, and we've always been right on, is stay invested. And it's not about the timing of the market, but it is the time you spend in the market. So from the bottom of my heart, thank you for your faith, and thank you for supporting, and thank you for being with us today. Many of you whom I see, I've seen from the very first seminars we would do, which would probably had about 10 people, 6 of them being Syfe staff, and seeing you here today in this packed auditorium gives me a lot of joy. So thank you for your faith, and we are always learning. Please give your feedback, and a lot more to come. Looking forward to build this business with you guys. Thank you.
All right, with that, thank you everyone for participating in this evening's session. There are a couple of booths outside. Please feel free to visit them as well. Thank you, everyone. Cheers.